Business Center. Now tonight the jury is out on how various banks are pricing their loans. That's 10 months since the government introduced the Kenya Bank's reference rate, that's KBRR, as a means of bringing down the cost of credit to single-digit levels. And it would appear little has changed since the new benchmark lending rate came into effect in July last year. The Central Bank of Kenya has now published the average margins that various commercial banks are adding onto the KBRR to price their loans. And it is from those published rates that we can now authoritatively tell you which are the cheapest and the most expensive banks to obtain a loan from. Now, the interest rate as at the close of March. Now, if you're shopping for a personal loan that is repayable for a period of over 2 years, Transnational Bank is the most expensive as it charges an average interest rate of 25.5%. It is followed by KREP Bank and Habib Bank at 24.4%. Guardian Bank follows closely at 20.77% and Equatorial Commercial Bank at 20%. Let's now look at the least expensive banks to take out a personal loan from. These are Dubai Bank at 12.91%, Family Bank at 14.62%, National Bank of Kenya at 14.71%, Commercial Bank of Africa at 15.3% and NIC Bank at 15.38%. Now, if you're looking for a mortgage to buy a house, the most expensive home loan is to be found at Consolidated Bank, which will charge an interest rate of 18.41%. It's followed by Gulf African Bank at 17.71%, Prime Bank at 17.5% and Jamii Bora Bank at 17.41%. Mortgages from Housing Finance and Equity Bank are tied at 17%. Let's now flip the coin for the cheapest home loan. Go to NIC Bank, which is charging 10.95%. It is followed by Family Bank at 12.49%, Barclays Bank 13.31%, Commercial Bank of Africa at 13.62% and Standard Chartered Bank at 13.9%. Finally, if you're running a small business, the most expensive SME loans are to be found at Habib Bank and KREP Bank, which charge an interest rate of 24.41%. Transnational Bank charges 21.13%, followed by Ecobank Kenya at 20.77%. and Equatorial Commercial Bank at 20.75%. Now, the least expensive SME loans can be obtained at African Banking Corporation at 14.63%, Commercial Bank of Africa at 14.81%, Bank of Africa at 15.69%, Guardian Bank of Kenya at 16.56%, and Standard Chartered Bank at 16%. Well, and to discuss a little bit more about what this means for you as a Kenyan, we're joined by Isaac Njuguna, Head of Investment at Zimele. Thank you so much for joining us. What's your reading of the just published interest rates that the banks are currently charging? Has anything shifted in the last few months?
I would say, first of all, I think it's important to note that this is the first time that we've received such information from an independent source at the Central Bank of Kenya. There were always reports that banks are charging high rates and they need to come down and so on, but nobody really had a general picture across the industry of all the banks, how much they were charging, and being able to compare that from one product category to another or from one loan to another. So by and large, I think it's a very, very good start. And I think the issue that is likely to come out of this is competition, because like you noted earlier, the fact that some banks are charging considerably lower than their peers means that there's definitely room for lowering interest rates, or rather lending rates. So that should definitely stir up the market and make competitive forces start causing rates to adjust downwards.
But why is there such a huge disparity? I mean, we're seeing loans where one bank is offering, 10-point-something% and you have another one charging 25% on the same type of loan.
I guess there are very many factors you need to consider when you're looking at the pricing of loans, and I think one of them is probably the profile that of the customers of these banks. Some of them are what you'd regard as mainly retail-oriented, where they're focusing on individuals and very, very small-scale businesses. Others are basically looking at corporate customers and individuals who are running, medium to large-scale businesses. So I think that in itself might probably influence what rates they are able to charge. And by and large, I think the large borrowers are able to negotiate for more competitive or more friendlier rates than the individual or the small-scale businessman. So that's the type of customer, I think, could be one of the factors that they are looking at.
Which I must say is very unfair, in this economy where we're talking about financial inclusion. Tell me, though, I know you said this is a good start, but in your opinion, do you think the bank referencing rate has actually worked?
I think we need to look at it from a policy point of view, and I think we also need to look at the implications, because I think what is being done here from a policy point of view is to tell the customer, first of all, you're trying to inform the customer, this is what the market has to offer. Now, it is no longer for you to say banks are charging high lending rates, therefore I am unable to borrow to expand my business, I am unable to borrow to acquire certain consumer durables. The list is out there, it's coming from the banking regulator, the central bank, so it's up to you now to look at which banks fit your wallet, so to speak, in terms of offering the more affordable or the lowest rate in the category that you'd be looking for. So I think it actually empowers the borrower to actually be able to walk around and know these are the banks that I need to start talking to if I have a loan. Or if I'm looking to borrow a loan. Secondly, the people who've already borrowed and are finding that their banks are in the higher category now have a chance to actually go and negotiate for lower rates, because they can argue, looking at their credit history, is it good? If it's good, they've been paying their loans on time and so on, so why should they end up paying considerably higher than what other borrowers in the other banks are paying? So it starts a debate.
All right, so are you saying that in this case that now as a borrower you can actually go to the bank as an individual borrower who's perhaps shopping for a personal loan and say, I would like to borrow X, if the rate is at what, 12%? So you can negotiate as an individual to take it lower? Absolutely,
you can do that. In fact, now one of the developments in the banking industry, or rather on the lending side, is the credit reference bureaus. Now these are organizations that collect information on borrowers, credit history in terms of, are you a good borrower, have you been paying your loans on time, and so on. Now using that information, assuming you haven't been delaying your payments and so on, you can then now go to your bank and say, look, I think I've been a good customer, I've just received my credit report, it's showing that my credit worthiness is quite good, so why don't we start a discussion about lowering my rates, especially now that I'm seeing my contemporaries borrowing at considerably lower rates than you are lending me as a bank.
All right,
so it starts that discussion.
Okay,
yes.
And we'd like to get into single-digit rates in just a moment, but first we'd like to run some of the rates that have been compared across the banks. If you're shopping for a personal loan that's repayable for a period of 2 years, Transnational Bank is the most expensive, as it charges an average interest rate of 25.5%. It's followed by KREP Bank at 24.41%, Habib Bank at 24.41%, and Guardian Bank at 20.77%, while Equatorial Commercial Bank charges 20%. Let's look at the other side of the coin. If you're looking for the least expensive loans, Dubai Bank gives you a loan at 12.91%, Family Bank 14.62%, National Bank at 14.71%, Commercial Bank of Africa 15.3%, and NIC Bank at 15.38%. Now, if you're looking for a mortgage to buy a house, the most expensive loan is to be found at Consolidated Bank, which will charge an interest rate of 18.41%. It's followed by Gulf African Bank at 17.71%, Prime Bank at 17.5%, and Jamii Bora Bank at 17.41%. Mortgages from Housing Finance and Equity Bank tied at 17%. Now, for the cheapest home loan, go to NIC Bank, which is charging 10.95%. It is followed by Family Bank at 12.99%, 12.49%, Barclays Bank at 13.31%, Commercial Bank of Africa at 13.62%, and Standard Chartered Bank at 13.9%. Well, finally, if you're running a small business, the most expensive SME loans are to be found in Habib Bank and KREP Bank, which charge an interest rate of 24.41%. Transnational Bank charges 21.13%, followed by Ecobank Kenya at 20.77%, and Equatorial Commercial Bank at 20.75%. Now, the least expensive SME loans can be obtained at African Banking Corporation at 14.63%, Commercial Bank of Africa at 14.81%, Bank of Africa 15.69%, Guardian Bank of Kenya at 16.56%, and Standard Chartered Bank at 16%. Isaac, tell me, is the dream of attaining single-digit interest rates on loans, still achievable? I remember, last year when those, earlier this year with the whole hullabaloo of the KBRR and how it's going to bring down the rates. We're still seeing loans at 25, 24%. Is there any hope of seeing a single-digit interest rate?
In the current environment, I don't think it is very, very likely. Looking at some of the various indicators that would go into pushing interest rates down, they don't seem to be on our side. And I think one of them perhaps is the trend in inflation. And the higher inflation is likely to be, the lower the likelihood of interest rates coming down. Another, I think, is also the general direction of rates as far as the government borrows. And I think here we need to look at, longer-term borrowing, because when you look at most of these loan categories, they are probably from 1 year, going all the way to perhaps 5 to even 7 years. And I think when you look at the pricing of these loans, one of the components that goes into the pricing is the cost at which the government is borrowing money from the public, which is considered to be lending at zero risk. And in this case, you'd be looking at treasury bond rates from 2 years all the way to 7 to 10 years even. Now, unfortunately, when you look at the current interest rates on treasury bond, none is below 10%. So if you're taking that as a reference rate of borrowing at no risk, and yet all these rates are above 10%, then it means for the time being, until we bring down treasury bond rates to below 10%, the dream of interest rates of below 10% are going to be very, very difficult to attain.
Tell me, what more tools can the government use to influence the cost of credit? For example, can the CBK come up with an information portal, such as what we have seen in this comparative table, where Kenyans can constantly have a place to find information on what banks are charging?
I think what was missing initially was information to empower the customer to actually know where to start shopping for the cheaper loans. Now that is available, so that's a very, very good start. Second, I think you also need some policy interventions to ensure that in the longer term, lending rates are actually going to go down below 10% without much pressure on banks. And I think when you look at that, it means, for instance, that the government needs to be borrowing less from the domestic market. The more the government borrows, the less is available for other investors, and the more interest rates are likely to go up. So once the government removes itself from borrowing so much domestically, it might actually cause interest rates to go down on treasury bills and treasury bonds, and automatically banks are going to be compelled to lower their interest rates accordingly. But I think also to be also fair, there might also be a case for some form of a legislative action, that CBK on its own might not have the tools to actually cause or influence interest rates to go down on a permanent basis. And that's where they need to be empowered through Parliament, just like they have the CBK Act that guides their activities. They need to have a similar legislation for interest rate influencing, so that they would actually be able to pass this on to borrowers. Okay,
as we wind up now, the CBK Monetary Policy Committee has announced that it's meeting early next month. That's, of course, a month earlier than was expected, and there's mixed views on what to expect. Some saying, it might not be good news for Kenyans in as far as interest rates are concerned. What are your expectations from that meeting?
Well, reading again on the indicators, because I think when you look at this, the CBK's primary objective, it's to ensure that inflation is low and stable. And when you look at the dynamics playing out right now, especially the direction of the shilling, which of course is more or less has been weakening very, very significantly, it means action has to be taken. The usual remedy for weakening shilling is higher short-term interest rates, or rather raising short-term interest rates, and which is what has not happened in the last meeting that they held. They were expected to adjust the CBR, central bank rate, upwards, but they left it unchanged. Unfortunately, from that time to now, the dollar has been gaining very, very heavily against the shilling. Now, there's an anticipation that this meeting, they might take some actions, administrative actions and policy actions, to try and control the slide of the shilling, more so because of its influence on inflation. We are mainly an import-dependent economy. Most of the commodities we bring in are imported, and a weak shilling basically means inflation down the road is going to be higher, cost of living is going to impact negatively on consumers. So it doesn't look like the information that's going to come out there might compel them to maintain the CBR where it is.
All right, thank you so much. Isaac Njuguna, Head of Investments at Zimele, joining us just to give us an insight into the just published interest rates. Isaac, thank you so much.
Thank you, Terry.
All right, and Michael Njenga is back to